Welcome to the look ahead video for the week starting 18th of March. Now, why do we look at these events? It's because we're looking for highly probable trading outcomes. And it doesn't work out every time. And this time we're going to have a look at a trade that didn't work out that we were expecting to from last week. So check that out here. Now, not every trade that's a high probability opportunity works out, and this week we saw a trade that was a high probability opportunity but just didn't work out, or it might have worked out, but it wasn't an obvious or straightforward trade. So let me just unpack this. On the Tuesday the 12th of March, we were looking for weak UK payroll data and strong US CPI inflation data to give us a potential pound US dollar sell bias. Now, this sort of played out during the course of the day. We were looking for this before the event, printing this out the night before, and we were looking for this before the event. But when we had the weak UK labour data, it wasn't weak enough for a definite pound sell bias. But when we had the strong CPI print that came in later in the UK afternoon, there was a clear and obvious pound US dollar selling bias. Yes, everything was ticking the boxes. We're seeing weak UK labour data, which could give the Bank of England a potential reason to look towards cutting interest rates. Certainly would be pound negative in the short term. And then the CPI print moving higher could potentially give the Fed food for thought and should result in dollar strength. That's what you typically expect. However, the reaction was not quite what we anticipated. Now, if you look at the print, you can see here that yes, the CPI print up towards the high of expectations month on month for the core, in line with the prior. The core was up in line with the high end of expectations, so it was 0.1 basis points higher, should have been enough to support the dollar. Month on month, 0.4% above the prior of 0.3, and the headline year on year, 3.2 above the prior of 3.1. So on balance, although it wasn't exactly what we said we're looking for on the cheat sheet, it was good enough. You can see there's no revisions lower. It is higher. This definitely should have given us a firmer dollar print. And if you look at the data with the UK that came out earlier as well, you can see there was a clear, unemployment rate higher, average weekly earnings, wage data, very important now for the Bank of England, lower. So with the hot CPI, weak UK labour data, a clear pound US dollar sell bias was in place out of this CPI print at 12:30. However, look at the way the market reacted. Initially, we saw the snap reaction we expected, which is dollar buying, but that quickly faded. And when the pound US dollar went above the pre-release price, see there's 12:30. So once the price moved above that pre-release price here, that was enough reason for me to exit the trade because something wasn't right. The dollar wasn't finding strength in the same way that it should have done. And if you notice that dollar strength, yes, it came in, but just a few hours later, all that dollar strength had faded. Now, it just goes to show that even with the highest probability opportunities, not every trade is going to work out. So that's why there has to be a place where you get out. There has to be an area where you say, okay, the analysis is wrong, the market's not behaving the way it ought, and that's why always getting out above that pre-release price is what makes sense. Now you can see ultimately, as we went through the week, we had another print, the hot PPI print, we had firmer jobs data, missing US retail sales later on in the week, and then we started to see some of that more dollar selling, which you would expect. But even there, you can see the way it was choppy on the release. So it was a very tricky week this week, and just goes to show you that not every trade is going to work out, even when you're putting the highest probability tradable opportunities. Sometimes the market can surprise you in the way that it reacts. So that's why it's important to always limit and be very acutely aware of the risk that you have at the market and on the table, so that when the unexpected does happen, it doesn't totally derail your trading plan or mess with your trading psychology. So you will have losing trades even when you're putting the odds in your favor. But you can see that that's what we're trying to do, is identify those high probability trading opportunities so that you can take advantage of them when they do appear. Now, generally speaking, when you have a high conviction probability trade, the market tends to move in one direction. So that's why we're looking for clear opportunities that can give us a high conviction move. So for this week, we've got two major central banks meeting quite early on in the week on Tuesday. The first is the Bank of Japan interest rate decision. Now, there's been increasing anticipation that the Bank of Japan is going to be exiting negative interest rates. And at the moment, markets are in a coin toss. Are they going to exit negative interest rates on the March meeting, which is the one coming up on Tuesday, or are they going to exit negative interest rates in April's meeting? Now, the conditions are broadly in place. They've had the latest wage price data from Rengo, and that is indicating a significant uptick in wages being paid to employees in Japan. So the path is clear for the Bank of Japan to exit negative interest rates. The only question is will they take this March meeting to do so? If they do, they will surprise markets, because short-term interest rate markets, as you can see here, are only pricing at about a 41% chance of a hike, and most economists don't think that the Bank of Japan will exit negative interest rates. Some do, but the majority is tilted for the Bank of Japan keeping rates unchanged. So we'll have to see what they do. If they do hike interest rates, that should surprise short-term interest rate markets and should give a bit of upside in the yen, though it may be limited, because this potential exit of negative interest rates has been very well signalled, and I think focus will very quickly shift onto the forward guidance and how fast they're going to be continuing to hike interest rates and what they're doing with their quantitative easing program, how they manage the exit from their yield curve control program as well. After the Bank of Japan interest rate decision, we have the RBA interest rate decision. Now, what the RBA have done is they're kind of in a holding position. They're keeping rates unchanged, and they're expected to keep rates unchanged. Again, if you look at the latest CPI print, you can see, yes, it is down from the general trend, but it's still well above the Reserve Bank of Australia's 2% target. Governor Bullock has said that we don't have to wait for inflation to get down into target before cutting interest rates. So it's going to be very interesting to look at the forward guidance and to see what the Bank of Australia is thinking about the near-term path of rates. Obviously, the latest GDP print was a little bit mixed, so we'll have to see what the RBA do. But the best opportunity would come from a clear signalling of rate cuts coming faster than the markets expected. Then you could easily see some Australian dollar downside, particularly against the New Zealand dollar. Then as we go through the rest of Tuesday, Canadian CPI print is the most interesting print. Now, the Bank of Canada have been keeping to an on-hold stance as well, but they do explain that there are upside risks to the inflationary outlook. So if we see inflation surprising markets and coming in above what markets are expecting, then we would expect that to lift the Canadian dollar and just keep the Bank of Canada in a sort of holding position, particularly if inflation is providing a more problematic picture than they're expecting. Then going in, of course, to the UK CPI print. Now, this is going to be a very interesting one. The Bank of England are keeping interest rates high and have been continually stressing the worries about inflation. At the last Bank of England meeting, two central bankers from the Monetary Policy Committee, they indicated that they're expecting hikes. Dingra expressed a cut, and the other six members were neutral. So what we're looking for here is something that clearly shows the Bank of England that they're winning the inflation battle. If we see this coming in below markets expectations, we could see a very sharp sell-off in the pound. And if we're looking at the latest sort of CFTC report and CFTC data, you can see that the pound is very stretched to the upside. So we're looking for a good opportunity to short the pound, and a potential would be a very weak CPI print. That's one not to miss on Wednesday, 20th of March. Now, on top of the CPI print, we also have the Federal Reserve meeting later on. And this is going to be crucial in terms of the near-term path of the dollar. And what markets can be looking at is the dot plot. in the December meeting, the Fed projected 3 interest rate cuts coming for this year. Do they still think the same? How many interest rate cuts are the Fed seeing? They could easily change the path, the near-term path of the dollar by maybe indicating only 2 interest rate cuts this year, or 1. Or do they see things needing more interest rate cuts? Jerome Powell has recently said that the US is not too far away from cutting rates. So it'll be interesting to see what happens from the Fed on Wednesday, and that could easily be a bit of a near-term driver for gold, for bond markets, and for the dollar. We will be covering that in more detail as we get nearer the time. New Zealand GDP, again, exactly how New Zealand are doing is going to be interesting. Generally speaking, inflation pressures are expected to rise for New Zealand, and inflation is expected to be more problematic than the RBNZ are necessarily thinking. So there's a bit of a difference here between what analysts are saying and what the RBNZ are saying. So if there is a big drop in the GDP print, then that could put some pressure on the RBNZ to maybe look at cutting rates and moving to a more accommodative stance. If you take a look at the short-term interest rate markets, they are pricing lower rates, and around 100 basis points rate cuts they're expecting between now and the 28th of May coming up sort of next year in 2025. So there are lower interest rates expected, but inflationary pressures may make that more difficult. If we see a very weak print in the GDP data, that could allow the New Zealand dollar to weaken, maybe a bit of Aussie New Zealand dollar upside, particularly if we saw a more hawkish RBA. We'll cover it in more detail at the time, but it is one to have on our radar. Then as we go through into Thursday, Aussie jobs data will be important. This is the February reading, the first reading back from the seasonally adjusted, some analysts are really cautious about the outlook for employment data around January. So this February print will give us a better picture of where employment really is for Australia. Then we have the SMB meeting, nice and early. That's coming in at 8:30. Now, the Swiss National Bank haven't got the same issue with inflation as others have got. So if you just take a look now at the Swiss inflation data, you can see it's coming in at 1.2% for February. That is a significant drop from these other highs, and you can see it's below the SMB's target as well. So what will be interesting to see for the SMB meeting is, do they give a surprise interest rate cut? If you look at short-term interest rate markets, they're seeing about 28% chance of a cut, and Ster markets see between now and September, they see 3 interest rate cuts. Don't rule out a possible surprise. Maybe the SMB will cut interest rates maybe 50 basis points. There could be a surprise here. So we'll definitely be looking at this SMB decision. And if we do see a surprise cut of 25 or 50 basis points, then we can look for some significant selling in the Swiss franc. So that's a really interesting decision that we will want to be keeping our eye on. Going into the end of the week as well, we got Bank of England's meeting. The last interest rate decision saw 2 members voting for a hike, 6 unchanged, 1 for a cut. Be interesting to see, have some of these more aggressive members, Haskell and Mann, have they pulled back from their hawkish outlook? Very unlikely that Mann has. I just wonder about Haskell. So, and what about these other members who are unchanged? Are they moving into the dovish camp? Are they moving into the need for the Bank of England to cut rates? We're waiting for the pound to capitulate lower. Could this be the opportunity? It does remain to be seen. And then to end the week, obviously got Japanese inflation data. Could always surprise, or keep an eye on it, but not expecting any big moves. UK retail sales has the potential to move markets. German IFO data, Canadian retail sales, sort of some gentle data points to end the week, may be sort of eclipsed by some of the bigger decisions that we've got coming up, but we'll have a look at that near the time on Friday. But for now, that is the week ahead. In terms of this, any other major drivers, we will update the cheat sheet as we go through the week. and I hope you have a very good week. Take care and speak soon.